Now, if you're in the market for income-paying funds, fees are really important because they eat an enormous slice of what's paid out each year. So in this video, we're going to have a look at some income ETFs as a really cheap way of investing for income. Hi, I'm Marcus De Silva and welcome to the Steps to Investing YouTube show, helping you beat low interest rates with really simple tutorials and strategies that get you investing in the stock markets and earning a better return. Now also please like the video and subscribe to the channel and turn on notifications for the latest, and also send us an email if you've any questions. We'd love to help. My email is marcus@stepstoinvesting.com. Now, income investing is a really appealing strategy for those wanting to invest their money and get paid out a percentage of that investment each year, known as a yield. And it's pretty tried and tested. There's plenty of income funds out there to choose from, and many of them have a pretty decent track record. But there is a problem. If you're investing primarily for income, then high annual charges can seem punitive. If a fund's yield is, let's say, 4% of your investment, you might balk at paying a 0.8% annual fee. This is where income ETFs can be quite good. They offer a really cheap way of investing in income stocks. So today we're going to have a look at what income ETFs are, the pros and cons of using them, and then go through 4 ETFs to give you some investing ideas. Now, just as a reminder, these are not recommendations, nor are we being paid to mention them. Now at the end, I'll share a link to a free investing magazine that Steps to Investing produce. It's called Get Investing, and it's stocked full of loads of interesting investment ideas. So stick around for that. So what are ETFs? Well, in the realm of investing, we have actively managed funds with investing overseen by a fund manager, and then we have passive funds, which include ETFs, which do not have an investment professional selecting stocks, but rather they're simply designed to mimic an index and then buy all the same stocks in all the same proportions in that index. If it is a FTSE 100 ETF, it would hold all the same stocks as the FTSE 100 index. ETFs also have shares that are traded on an exchange, and this makes them pretty easy and quick to buy to. Now, if you want more detail on this, we have a video which explains all the different types of funds, so just wait to the end of the video and we'll show you where that is. So what are income ETFs? Well, they're similar to the main best known ones that track flagship stock market indices such as the FTSE 100, but instead of buying all the stocks in the FTSE 100, a UK income ETF invests in the best dividend paying stocks in the London market. That's income that you receive from shares. This is done by creating a set of rules for picking income paying stocks. And then all the stocks that comply with those rules go into a particular income index. And then the income ETF just tracks that index. All right, let's have a look at an example, the iShares UK Dividend ETF. Now this is a UK income ETF and it tracks an index called the FTSE UK Dividend Plus Index. This particular index comprises the 50 best dividend payers in the FTSE 350 index. It's the largest 350 stocks in the UK. The index is rebalanced every 6 months and stocks are added or removed based on their yield over the last year and then their forecast yield for the year to come. Different ETFs follow different indices, but the basic concept is the same. So what are the pros and cons of the passive income approach? Well, the biggest plus point for income ETFs is that they're relatively cheap. The iShares UK Dividend ETF, which we mentioned, has an annual charge of 0.4%, while some rival income ETFs have lower charges at around 0.3%. If you went for an active fund with a fund manager selecting stocks for you, you'd likely be looking at charges of around 0.8% or higher. Now, there's also no risk of a fund manager making dumb decisions. The best example here is disgraced fund manager Neil Woodford. His biggest fund was the Woodford Equity Income Fund, and given its name, you'd imagine it only invested in dividend-paying stocks. But that wasn't what happened. Woodford started investing some of the fund in ultra-risky unlisted stocks. so private companies in other words. This is known as style drift, and that won't happen with an ETF. In fairness, most income fund managers do stick with income stocks, but there's still a fair chance they'll pick the wrong stocks and the fund's performance will be disappointing. The rules-based approach of income ETFs should be more predictable. I think what's more, income ETFs pay decent dividends as well. The iShares UK Dividend Fund currently has a yield of just below 4%. And this was higher before COVID hit, company payouts, and lots of dividends were cancelled. On the downside, income ETFs tend to be more expensive than the ETFs which track a broad index like the FTSE. Some of these broader ones have annual charges of below 0.1%. It's also worth noting that there's plenty of history supporting an investment in broad markets, as long-term investments in a market like the FTSE 100 do tend to do well over the long term. These flagship indices have been around a long time, and although there are no guarantees for the future, the historical case is certainly strong. With income ETFs, the indices are often very new too, and they may have been designed to look good retrospectively given the dividends that have been paid. There is also a risk that an income ETF may become overinvested in one or two sectors. This happened in the run-up to the financial crisis when the iShares UK Dividend ETF, under a different name, became overexposed to banks and then suffered as bank share prices collapsed. All right, now for 4 ideas of where to invest for some passive income. Okay, number 1, the iShares UK Dividend ETF. Now, we've already seen that this ETF tracks the 50 best dividend payers in the FTSE 350. Its top holdings include Imperial Brands, GlaxoSmithKline, and British American Tobacco. It is heavily exposed to 2 sectors. 25% of the fund is invested in financial services and 19% in materials. In its favour, the ETF is relatively simple and has been around since 2005, which means there's very little danger of it being wound up. Okay, number 2, the LGQ Quality Equity Dividend ESG Exclusions UK ETF. Now, this is a much newer ETF. It was launched in April 2021. It is also pretty cheap, with an annual charge of just 0.25%. It comprises some of the best dividend payers in the FTSE All-Share Index, which means the fund may contain some stocks that are too small for the iShares UK Dividend ETF. The underlying index comprises companies with a long track record of consistent and rising dividends, and which have the potential to sustain those dividend increases. There's also a filter to exclude companies that have low ESG ratings, that's environmental, social, and governance ratings. It explains why the top 10 holdings don't include any tobacco stocks. The largest holding is BT, and there's a strong tilt towards financial stocks. 28% of the ETF is invested in that sector. Okay, number 3, the Vanguard FTSE All World High Dividend Yield ETF. At 0.29%, the charge is attractive, and this ETF gives you exposure to income stocks around the world. Many global funds are heavily exposed to the US, but that's not the case here. Only 40% of the ETF is invested in US stocks, which is actually pretty small. 2 of the largest holdings are emerging market growth stocks, Taiwan Semiconductor and Samsung, but there are plenty of less surprising names elsewhere in the top 10. These include JP Chase and Procter & Gamble. As with the UK ETFs, this fund is also heavily exposed to financial stocks. They comprise 25% of the fund. Okay, number 4, the iShares MSCI Europe Quality Dividend ETF. Now, this ETF gives you exposure to 54 European income stocks, including some in the UK. The largest stocks include consumer stocks such as Danone and Unilever, along with pharma stocks like Sanofi and Novartis. Once again, exposure to financial stocks is quite heavy at 23%, but the annual charge is just 0.28%. Okay, in summary, high annual charges can take a large slice of the payouts from conventional dividend income paying funds. income-paying ETFs are a cheaper way to access dividends. No style drift is possible as there's no fund manager. Look out for overexposure though to a few sectors. Well, we hope you enjoyed the video. Please don't forget to click on the link and read that magazine. It's free and it's full of loads of different ideas and bits of education. And also like and subscribe to the channel as well. We need lots of your support. Until next time, goodbye.